Hi, Gary Klaban here. Welcome to our third quarter Market Observer. I'm being replaced by John Finley. He's our Chief Investment Officer, does that full time, and he's going to be doing now and going forward commentary with Kevin Coyle. Enjoy.
Hello, Kevin Coyle along with John Finley, our Chief Investment Officer, with our third quarter market update. The last update we did, John, was in May, the one I did with Gary, and we were largely flat, maybe partially up for the year. And we had an interesting experience in January where we had a bit of a decline. Since then, we had the Brexit occurrence and a decline in June. But since that time, we're up just shy of 7%. And interestingly enough, if you look back to January of 2014, that's about the same rate of return that most of our returns over the last since January of 2014 through now has occurred since the Brexit occurrence. What's changed in your mind since that time?
Well, we had the uncertainty around oil prices back in 2014, which hurt energy companies considerably. So a lot of the drag on earnings, which drive valuations in the stock market, are related to energy and the uncertainty around oil prices. We had the dollar as well as a drag on earnings. So markets will incorporate those kinds of uncertainties by seeing more volatility. But since Brexit, and when we've looked at the earnings estimates for, at least in the U.S., the S&P 500, that they're expecting a very robust energy sector next year. So with the energy sector contributing instead of detracting from earnings, I think the markets are taking that into account, plus the fact that we've got a very accommodative Fed and other developed central banks following suit, that they're going to underpin markets going forward. Now, having said that, we're not expecting, a lot of market returns, excessive returns going forward, with global growth considered to be real growth being relatively stagnant going forward. But nevertheless, we're not looking for any severe global recession, and the indicators that we look at are not showing a very high probability.
Well, you have interest rates at 1.5% still in the 10-year Treasury. You have inflation tame still.
Right.
So you have a large amount of global debt there, but you still see moderate earnings growth. So having the dollar decline being behind you, with having the energy issue being behind you, some of the forecasts of recession might be resulting from that appear to be waning.
Right.
So at least we see positive growth, albeit slow, right?
Right.
So market being at roughly 17.5 times earnings, something like that, not a traditionally hugely value market, but not grossly overvalued either, especially with interest rates where they're at.
Well, we've got bright spots in the U.S. economy with labor markets and housing and manufacturing struggling a bit, but there's still some positive news on the economic front that would suggest that recession is that much less likely, at least over the next 6 to 12 months.
So I guess we'd be remiss if we didn't at least touch on the final topic as we approach the November elections. Anything you want to throw in the commentary?
Well, election years are always interesting, and but history has shown that whoever gets into the White House from either party doesn't have a big impact on the market. And surprisingly, some people who predict bad things to happen, often good things happen, or vice versa.
Well, it's interesting too. I mean, post-Brexit, the market's up, since that period of time. So it's obviously there's other issues besides just the headline news that are really driving things. Mm-hmm. Well, if nothing else, we'll have hopefully something interesting to talk about in our next update as we get through November. In the meantime, enjoy.